back. Let's take a look at markets this morning. As you can see, yesterday was a rough one. The S&P 500 and the NASDAQ tumbled yesterday, the worst day since 2022, as Tesla and Alphabet earnings and the sell-offs in their stocks dragged down the broader tech area. The Washington Post writes this: a growing group of Wall Street analysts and technology investors beginning to sound the alarm that the immense amount of money being poured into artificial intelligence by big tech companies, stock market investors, and venture capital firms could be leading to a financial bubble. Joining me now is the Fitzgerald Group principal, Keith Fitz-Gerald. Keith, good to see you. Thanks very much for being here. We're talking about bubbles now when we look at stocks that have outsized gains. Your reaction?
Well, I don't think the term bubble is right. I think there's a lot of money on the table, and Wall Street's doing what it does best. They're simply collecting profits, and they're going to realign. You're talking about an industry that's going to contribute trillions of dollars to the world economy, that's going to employ 200 million people, that's growing at 40% a year, that China and India are pushing aggressively into. So this is a matter of strategic priority. It's simply out of sorts with the term.
Well, I mean, are they too expensive? Yes, you're right. This is an area that is expected to grow, and that's why the stocks have been on the move. But are they getting ahead of themselves?
You know, I don't think so, and here's why. I don't think our accounting regs accurately reflect digital investments. So my view on this is very controversial. It's unpopular. I think they're actually dirt cheap, but you've got to get past the PE ratios, which are outdated and outmoded, giving our accounting regulations. Bubble, again, is a debatable term.
Rebecca, how do you see it?
Well, I hate to disagree with Keith, but I do think that there's just been so much irrational exuberance into the AI tech space for this year. You know, when you have 29 cents of every dollar that is invested in the S&P SPY ETF that goes into the top 5 stocks, this is a concentration unlike anything we've ever seen. And while we've seen some rotation out into, you know, the smaller stocks and small cap, this needs to really rotate out, Maria, and so therefore that does indicate a bubble to me. And certainly pre-election, with the world going crazy and on fire, it does confident.
Well, markets have been hot this year and last year. Keith, let's look at interest rates. One of the reasons for this strength in stocks is this expectation that rates are going to come down. This morning, the 10-year yield this morning sits at 4.22%. That's down 6 basis points ahead of the first read of the second quarter GDP out this morning. It's coming out at 8:30 a.m. Eastern. Economists are expecting the economy grew 2% in the last quarter. We'll also get the Federal Reserve's favored inflation measure out tomorrow. That's the June PCE index out tomorrow. I want to get your expectations, Keith. We do have new data from the Philadelphia Federal Reserve, finds that the share of past due U.S. credit card balances are the highest since 2012. Have been buying, but they're putting it on their credit cards, Keith. That has been a worrisome sign.
Well, it's been a worry for me for a long time, because I maintain that Chairman Powell set out to destroy this economy and slow it down, and the data is beginning to reflect that. So he's playing a very, very dangerous game. The economic data is going to reflect new urgency for a rate cut, for him to take action, as opposed to simply punting.
I want to get your take on what we see next in terms of this broader macro story. Looking at the labor market, ZipRecruiter's quarterly survey finds that job seeker confidence in the second quarter fell to the lowest level in more than 2 years. Workers are souring over this labor market that seems to be cooling down. The Wall Street Journal writes this: the hottest job market in a generation is over, and many economists see a jobs market that has come back into balance, though some worry that the conditions could worsen. I spoke with Piper Sandler's managing director and senior economist Jake Ubina yesterday on this program. He says waning productivity and pricing power should accelerate the cycle of layoffs. Watch.
So I have a lot of sectors that look very overhired from a productivity standpoint. A lot of these fall into the stay-at-home bubble. You could already make a case that you need to right-size businesses because of that. Productivity well below 2019 levels. Now it's starting to happen, and the reason companies haven't been firing people more aggressively is because they've had pricing power. They've been able to push price because of massive amounts of fiscal stimulus. That's now starting to wane. We've got deflation risks that have picked up in a lot of pockets. You have over-inventoried areas of the economy. It's not just a normalization process. People oversave. Companies overfire, and so the tails of this are a little bit bigger than that. We're exiting this year with a 5% unemployment rate, probably going to 5.5% by the time we're in this stage next year.
So, Keith, what's your take here? Are we looking at a jobs market that will continue to weaken and perhaps spur the Fed on in September?
Well, again, I hope the Fed is finally going to wake up and realize the damage that it's done. I think they've caused the next several crises. I agree with Jake. I think he makes some very, very sharp points here. But, there's another twist, too. I think that it's not necessarily a lack of confidence in the job market. It's the dawning realization from many people we talk to that the era of free money is over. They can't just walk in and claim to be an AI or a tech person and get a job. They can't just walk down the street and collect a paycheck. They're actually going to have to be productive. They're actually going to have to work. So this is a two-way street as far as I'm concerned. It's certainly reflected by the candidates we talk to in our office.
Do you want to put new money to work in stocks right now?
No question. For all the reasons that Rebecca and I disagree, and as smart as she is, again, I'm going to respectfully push back. I think this is the time to go shopping, and I've been doing that the last couple of days.
All right, Keith, great to see you this morning. Thanks very much. Keith Fitz-Gerald joining us.
Thank you.
Your morning mover is Ford Motor. Take a look at the stock and the pre